Money Matters with Mike Hill and Casey Harding here. I didn't even let him talk this time. I'm going to point to him and he talks. But hey, we did get the vest memo, so it's going to be blue versus red team now. But we're all vests today, this spring weather. But we have done a bunch of these podcasts. We've done more where it's informational. We brought in Allison. She's off camera because she doesn't want to be on camera, but I will tell you she's at this point 8 months pregnant, and we're just lucky to get her to where she doesn't yell at us for 20 minutes. No, okay. So you're doing a great job. But she's going to be she's already looking at me like I'm not asking any questions to you. But we really appreciated the amount of subscriptions. We're getting a lot of subscriptions. Keep sending and sharing. Instagram. I don't even know what our Instagram page is. I know, but it's doing well. And then Facebook, we're just very excited, and that's why we're continuing to do this, because we have grown our subscriptions probably.
Yeah, no, it's been great. People are
900%. And I'm doing quick math. I'm
getting information, sharing with people.
And thank you all for the questions. Thank you for the feedback. We use those for future podcasts, so please send comments or email us, etc. But this is Money Matters right here in Midlothian, Texas, otherwise known as the 3M. Podcast, I guess, if we're going to do that. But so and by the way, we did this last time, but just to prove that we're in Texas, I got my boots on. And
I've got my boots on.
He's got his boots on. So we're all pure Texas here. Second time I've done that on a podcast. So then you start stretching. So without further ado, Allison, just go ahead and.
What you got for us, Allison?
Yeah, so today we're doing a current events Q&A. And so I have some questions for you guys, and I'm going to start off with the first one, giving Michael the opportunity to talk first, and then Casey, and then Casey can follow up with that.
Perfect.
So the first one is, why do financial headlines feel so overwhelming right now?
Well, you mean in the time where we have news now that is Fox News versus CNN, where it's no longer just Walter Cronkite reading the news. In the day and time of the last 25, 30 years, news has definitely become biased. I think it's more than anything, they thought it was boring. How do we compete with other shows? How do we compete with, TikTok and Instagram and
how do we
X?
People so
short attention
scared
spans.
that they tune in.
And it's just, something was said a long time ago, the easiest way to sell people is two ways, fear or greed. So if you get them scared, they'll do things that, those windows right there, those aren't safe for your family. Those windows, if you have a tornado, your whole family would know. Oh my gosh, I got to buy $20,000 worth of windows now. Thank you for telling me. Or greed. Hey, you invest in this, you're an idiot. You'll miss out because that thing will triple in 2 years. Those are the two ways, in my opinion, to grab people's attention. But rate changes, inflation, you're going to get a lot of headlines right now. A lot of headlines. With how does Greenland affect? We live in Texas. Great. We're going to get Greenland. We're not going to get Greenland. At the end of the day, what does it do when I go to the grocery store?
Yeah.
That's all you should be cared about. So, Casey, I'll let you. What are your thoughts on why headlines are such a big deal and overwhelming at times?
It's because they feed on fear. That's all that I can say about that. It really is. But the biggest thing is, like, with headlines, they're focused on today's news. They're not looking 10, 20, 30 years into the future of what's going to be happening then. And so that's what we really have to look at is, what has historically happened with markets, no matter what's going on, and how have those, times that affected markets, and then, adjust accordingly. We can't focus on the short-term news to plan for your retirement.
I think, and I don't want to spend too much time on this subject, but somebody that we worked with gave us a chart, and it gave us a big news headline every year that it come in. And it's just, the one thing I noticed about the stock market chart is if you look at it long enough, the right side's higher than the left side. It's a self-serving with 401k deposit machine. So you've had anything. I remember 3 years ago when Russia invaded Ukraine. Oh my gosh, this is it. The market's going to crash. Within a month and a half, the market's back where it is, and we're a lot higher now. And it's the war's still going on. But so it's to your point. It's like we're going to do things to sell you clicks and to get you to stay tuned, as opposed to give you real information.
How long can I keep you in the algorithm?
Absolutely. So I don't know if that answered it.
Yeah, no, that was great. So next one, I'm going to let Casey answer this one first, and then give Michael the opportunity to speak afterwards. So Casey, in your opinion, how do short-term market swings impact long-term retirement plans?
Yeah, they honestly don't have that much of an impact on, the overall portfolio. It really depends on how you're invested. It also depends on your time horizon. I mean, if you're 5 years out from retirement, that short-term, swing could affect things, but like we've seen, historically, market's only been down 3 times, 3 years in a row, one time in history. Yeah. So, as long as we've got, a little bit of time, I think the market, and especially here lately, I mean, with the last, since COVID, we've just seen market goes down, within a few months, the market is right back where it was and going higher. These pullbacks and these downturns have, are always, are even more short-lived than they have been historically. Mm-hmm. The market is recovering faster now than it did, 20 years ago. And I think it's because of the headlines and the news and how
well, you get a headline and buy a stock on your phone.
How easy it is to get people can invest on their phones, and you're getting information fed to your phone about business updates and market updates and all the things are you can get that information so quickly now. Trying to time the market at this point is just it's a roll of the dice.
Well, and that's sorry, I didn't, but I mean that's one of the things I keep thinking about, and I say this to clients all the time. Is Warren Buffett is the one. I mean, one of the best investors in the history of the United States. He says that market sell-offs are your friends, not your enemy. I mean, you got to have that way of thinking. Now, I'm not saying
you got cash on the sidelines.
Yeah, I mean, and it's perfect time to rebalance, but it's also I love our firm. I mean, I'm giving ourselves a plug, but we do the bucket approach. We don't put everything in one basket. Yep. We don't have accounts where it's all just growth, and we have accounts set up. One's for income, one's for growth, one's for extra. I mean, so I would say that how does it affect your long-term retirement plans? It shouldn't. If you have it diversified and you have it planned for 5 to 10 years, not 5 to 10 days. Yeah. If you plan on just living on your money for the next 10 days, yeah, it's a problem. But if that's the case, go to the Bahamas and enjoy the next 10 days, and who cares what the market's doing? Right. So I think long term, if you do not have your plan set up where at least a year's worth of income is set aside in low risk or just almost cash investments, then you need to reallocate it. So that way you can go through a year sell-off and know you're going to get paid, not worry about it.
Yeah, especially if you're in retirement. That's great.
Absolutely.
All right.
Yes, ma'am.
All right. Yeah, no. Michael, we'll just keep it rolling with you and then head to Casey. So, Michael, in your opinion, what do rising or falling interest rates really mean for everyday investors?
Oh, man, that could be a long question. Long answer, so and I am long-winded anyway. So interest rates affect mortgages, car loans, where you buy a couch, credit cards, savings accounts, everything. Interest rates. So, but there's a little bit of a disconnect right now. You have a Fed that's been lowering rates, and mortgage rates haven't come down. So how does it affect the consumer? You better be looking at the 10-year Treasury. The 10-year Treasury is what affects mortgage rates more than regular interest rates, but how it affects the average consumer on the investment side is now money market rates are lower, checking rates are lower, savings rates are lower, but the amount that they get to loan out money on mortgage rates are staying the same. So banks are killing it right now. Yeah. So investment-wise, that's an easy one. You like banks. When interest rates are going up, that means they're trying to stop inflation. So you buy inflationary things. Hello, gold. All-time high, silver, pretty close to an all-time high, because when they were raising interest rates, it was an inflationary tell. So how it affects you is it keeps you where you're looking at refinancing. If rates do come down, that can maybe keep you in the same house. Your equity will still keep going up, especially when interest rates come down. That typically means houses get more expensive because now you can afford more house. Yeah. So that may affect your equity if you're living in one, et cetera, et cetera. So I do think that if you have a lot of credit card debt, you're at a high interest rate anyway, and how a rising interest rates or lowering interest rates affect you is hopefully there's more 0% credit cards that you can switch to get those things paid off. But it's right now when rates fall, it's a little bit cheaper to get loans, a little bit more money in your pocket, but that also means that's in turn good for the stock market, because if you had a lot in cash, you're like, well, now I'm only making 1%. I'll just go buy me a dividend stock that pays 4%. That's typically the theory. So,
Yeah, no, that's exactly where I was going to go.
That's exactly where I was going to go. I mean, it's important, for income planning, looking for, bonds that are paying, 4 or 5%, or if, they're interest rate sensitive, we're looking at buying, dividend stocks, and so it's just finding, where we need to pivot and what, assets we need to be, kind of investing with our clients, depending on kind of what they're looking for there, and that bucket approach helps us, with that. And so, but from income planning purposes, the falling interest rates, it's really not affecting, too much other than what Michael mentioned. So
Yeah, but interest rates definitely drive, I think, 70% of our conversation.
For sure.
Right now. So I'm glad that was a good question.
Okay, Casey, we'll start with you. How much attention would you say investors need to pay to political headlines?
Yeah, that's a tough one. Not really, because we don't really need to pay attention to the political headlines. No, I mean, there, certainly, political parties and different administrations, are going to be implementing things that will shift the market. But it's really understanding what those administrations are emphasizing, and where you need to, what sectors of the economy you need to maybe shift and reallocate toward. And so that is really the biggest thing, is just understanding what's important as different administrations come in and go out, where the market, if you look, like you say in that chart, you look at it 40 years ago, look at it today, it's trending up, and that there's a lot of different, whether it's Republican or Democrat, it's all tends to trend up over, the period of time that we're looking at. So it's really just finding, what areas of the market that are important to that administration, and where we think the money flows are going to go, and how we adjust the allocation appropriately.
I think, I'm sitting there listening, and I'm like, this is just a really small fun fact, is over the last 40 years, when the president and the Congress and Senate are different, the market tends to have better returns in those years than when one side has every. So to my point, to your point, it's like, yes, be cognizant of it, but it's actually better when you have a little infighting. Isn't that funny? It's like everybody thinks, oh, finally the Republicans are all in, or finally all Democrats own all of it. Actually, it's better for you in the markets. Typically, history has shown, when you have a difference and then you have a balance of power. I will say that absolutely know what your candidate is as far as taxation. I'm not trying to get too political here, but look what's happening in New York City. Their taxes now are going to be above 50% per person. Yeah, you got free bus rides and all this, but that's also why a lot of wealthy individuals are leaving. So what does that do to your real estate portfolio, et cetera, et cetera? So it's important, but there's also a reason we have a presidential election every 4 years. It seems like it's every year nowadays. They start doing it 2 years early, but that's a good question too. With the midterm elections coming up, does the Republicans keep the House?
Yeah.
Do they not? I think if the Republicans lose the House or the Senate, it's going to be a tough 2 last years for Donald Trump to get a lot of stuff done. I think that's why he's got the pedal to the metal on getting all of his stuff done now before the midterm. So anyway, but to your point, are you a long-term investor? Because if you've had your money invested in the last 20 years, guess what? We've had a Democratic president, we've had a Republican president. We've had a Democratic House in Congress, we've had a Republican House in Congress. Your account's still up more than it was 10 years ago if you've just been anything in the market.
Yeah.
So. Anyway,
Awesome.
good question. Did you know the midterms are coming?
Nope.
She's focused on.
Yeah.
Okay.
We will go ahead and end on Michael, and with this last question, and then he can softball it over to Casey. Michael, in your opinion, how could upcoming tax changes impact financial plans?
Okay, by the way, we have these.
Okay, by the way, we have these printed off because I can't remember anything, so this way at least I can know what questions she asked me to look at. So that's why I'm looking down at that piece of paper. How does taxes?
That's a softball one.
That's a softball one. Well, first of all,
The first thing you look at.
the first thing you look at, especially in non-IRA accounts, is capital gains taxes. Capital gains taxes, have they owned it 12 months, they're going to pay a lower capital gains rate than if they've owned it less than 12 months. Capital gains taxes are right now historically at the lowest percentage they've been in almost 40 years, 50 years. So that's a big one. So when you're talking to somebody about putting money into a Roth IRA or a regular IRA, the first thing we ask is, did you get a refund? If you got a refund, why are you maxing out an IRA? Let's start putting money into a Roth. Did you have to pay money in? Then maybe you should be putting money into an IRA so you can get a write-off, knowing what your tax bracket is. How does it affect your financial plan? Okay, if you make too much money, now with the new Trump tax, the big beautiful bill that's now a law is now if you're 65 years old and you're single and you make less than $75,000 a year, you're going to get a $6,000 deduction on your taxes starting this year. So, long story short, how does it affect it? That's just one area. If you make too much money, your Social Security is taxed. So, what triggers that? Well, that hasn't changed since 1982. It would be nice if it would, but those are the things where we're involved and we're sitting there and we're planning for retirees for future income. It isn't just what your tax bracket is now. What is this going to look like when you're 65, 66, 67 and you're drawing money out? What are things we could do now, regardless of what the tax environment looks like in 3 years? So it affects you, but honestly, being so short-sighted to only worry about what it's happening this year, which with the capital gains,
For sure.
but long term, let's have the income plan where we take more money out of taxable investments than we do tax deferred. That's just my opinion.
No, that feeds into what I was going to throw out there. Was just that's why we kind of plan ahead with our clients, Roth conversions, charitable planning, withdrawal sequencing of when do we need to take the withdrawal, first of the year, end of the year, whether RMDs, all that kind of stuff factors in, so that we can come up with the best tax mitigation strategies.
It's a big word.
So. I use big words sometimes.
Yeah, no, you do.
Michael gets lost.
No,
I'm kidding.
I'm kidding.
No, that's really it. So
I know that's because I'm like, dang, I could have worked in mitigation. So Allison, I'm put you on the spot. I swear, she has no idea. Any questions? You're a young couple. You're having your first baby. Any questions for us as advice? You got two of the brightest experts in at least a 2 feet area. So if any questions you would have for like you and your husband, you're starting out, like I'm not going to give you softballs, but a financial question or a budgeting question or things that you would ask as a young couple coming in, or something that would be important.
When should I start? When should I start to invest? When do I need
yesterday.
That's what I can say. We got 5 daughters, have a 20-year-old daughter. We're setting her up right now to start putting in $50 a month into a Roth IRA, and then hopefully boost that up a little bit. But man, what you have on your side is your age, because everybody's like, oh, it's too much, I don't have the money. Yes, we talked about this on this podcast. You are a bill.
Yeah.
If y'all aren't putting money aside to pay yourself some kind of retirement, then you're missing out. And I get that all the time. I only make $40,000 a year. I only make $50,000 a year.
You're spending 50 because
you make 50. If you took home 46, I promise you your lifestyle isn't going to change. But what is going to change is you're going to be 50, and after 8, 9, 10% a year of growth in the market, you're going to look up and have $500,000, and maybe you could retire at 55 instead of 60.
Sure.
I don't know why I'm looking at you. I should be But no, when should you start? Absolutely as soon as possible.
Yeah.
Any answers?
No, I just destroyed the mics. No, that's exactly right. I mean, the earlier you get started, the longer you get that compounding growth, the better off you're going to be long term. So, all right.
So I'm going to let Casey,
Wrap it
because
up.
I sit here and talk way too much.
I do have
Yes,
a
ma'am.
couple of other
here we go.
questions.
Here we go.
How,
She Googled this,
how
guaranteed
do I
it.
start an HSA?
How do you start an HSA? There's 2 or 3 groups out there. Fidelity has one. Vanguard's, I think, stopped doing it. We use Fidelity's. But you just go directly online. There's a link we can share. But if you just Google Fidelity HSA, I mean, I can't remember the link off the top of my
Yeah.
head, but you're able to deposit it, set it up with your own checking account, and where you could have it pull funds or push funds. So let's say you go to the doctor's office or you get a bill, it goes directly into your checking account, and at the end of the year, you get a little receipt that says you took $3,000 out of your HSA, and you're able to show I had $3,000 of medical bills. Thank you. But you could also deposit it that way, and it even asks you what. Now those you have to do by the end of the year. It isn't like an IRA where you have till tax April. So if you can't do it for 2025 anymore, you'd have to do it for 2026. But an HSA, great question. We don't even, I mean, I refer those out.
Yeah,
We don't even do them,
just get people
but that's how much I believe in them.
directly.
It's you get tax write-off going in and it's tax-free coming out. And most of us go to the doctor at least once or twice.
Do you do a Roth before HSA?
That has more to do with maybe your own personal circumstance. Age definitely depends on that. But if it's you, I'm gonna lean towards. Well, I know you're having a baby, and I don't know how much is covered with medical coverage. So because you can have the baby covered under the HSA. So if you have a high deductible, I tend to lean to the HSA. But if you have a low deductible, I would lean towards the Roth.
Yeah, the Roth, yeah.
What are your thoughts?
No, I agree. I think, depending on what medical expenses you might have in a given year, you might, recommend the HSA, but I think we start with the Roth IRAs where I would lean towards that normally.
Here's the thing. Now they're saying there's a new law trying to push where HSAs can go towards gym memberships, where they could go towards, gym equipment. It's like, okay, man, I don't see that being taken advantage of at all. Yeah.
More like a lifestyle savings account at that point.
Yeah. But I mean, if you're working out and doing all that, it should help your health. If you don't eat donuts like me all the time, I might actually, have good blood work for once. But I mean, working out wise, it's
Maha, make America healthy again.
trademark TM. Nobody get that.
Well, that's all I have. So.
Good,
Great, perfect.
Good question. CN to put her on the spot. Casey,
No,
bring us
this
home.
was Money Matters with Hill Financial Group. Thanks for tuning in.
Thank y'all. Share, like, all the things.
Not every time, but
Every once in a while. I mean, it's good to have ones that we do long-term educational, but these are good for short-term.
Well, I think it. Oh, he's still going. Yeah. Dang, we're rocking and rolling these. That's
2:30.
3.
I think Casey's is in there.
You did 1, so this will be 5.
Yeah.
Wow, killing it. I nailed it.
Now I gotta make 5 more scripts for next time.
Gotta pump them out.
Yeah.
Did you stop?